Everyone's watching the ships. The news, your feed, probably you, all staring at a strip of water off Iran.
Brent moving higher after the US and Iran exchanged fresh strikes overnight.
Waiting to see what happens next. But me, I'm not watching the ships.
Limited strikes designed to protect shipping.
Because the last 2 times I stood in a market like this one, the thing that actually took people's money was never the thing on television.
The control of the Strait of Hormuz continues and intensifies.
It was something quieter. Something was already moving while everyone stared at the headline. In 2008, that quiet thing cost me most of what I had. And I wasn't reckless. I did what everyone said to do. I just didn't know the market has 2 layers. The one on the news and the one underneath that actually sets the prices. The headline is never where the danger lives. The danger lives in the plumbing. And right now, the plumbing is doing something I've only seen twice in 30 years. Both times, right before the floor gave out.
We're going to hit them very hard tonight, and we're going to hit them hard tomorrow, and there's not a damn thing they can do about it.
Before we continue, if you want more videos that cut through the market hype and show you where the money is actually moving, subscribe, because that's exactly what this channel is built for. Alright, back to the real problem. My name is Martin. I don't work on Wall Street, I don't run a fund, and I've got nothing to sell you. I'm just an investor who sat through the dot-com wipeout in 2008 and learned the expensive way that the headline is never where the danger actually lives. So here's what we're covering. How oil becomes inflation, how inflation locks the Fed in a cage, and how that cage crushes your stocks. Stay for that last one. That's the part nobody's pricing in. First, the one idea that makes everything else make sense. Energy is the baseline cost of the entire economy. Think of it like the concrete foundation of a house. Everything you buy, everything that's shipped, farmed, or manufactured, sits on top of the price of oil. So when oil moves, it doesn't move one line item, it moves all of them. Remember that, because it's the whole game. So what just fired? You probably know the setup. Roughly 1/5 of the world's oil and gas moves through the Strait of Hormuz, a channel narrow enough that one country can hold a hand over the world's fuel line.
Iranian state media earlier today reiterated a threat from the IRGC, which said that they are going to close the strait unless the U.S., quote, ends interference.
For a few weeks, there was a ceasefire, a deal on paper. Tankers started moving again, and the market exhaled. Oil drifted down. Everyone assumed the worst was behind them, and it turns out it wasn't. Trump and Washington called the ceasefire dead and answered with airstrikes. Twice.
Ceasefire over! Is the ceasefire done? Is the MOU dead?
It's a very interesting question. To me, I think it's over.
And the traffic data tells you the real story. When a captain would rather eat the cost of a wasted voyage than enter that water, that's not caution. That's a price signal. And oil answered the way oil always answers a choke point, sharply and in one direction. Now watch the chain. Because that shock isn't landing on a calm economy. It's landing on one where inflation was already running at its hottest in nearly 3 years before a single tanker turned around. CPI already hit 4.2% earlier this year, now sitting at 3.5%. This drags the inflation numbers up mechanically, which means the market's dream of rate cuts just died. And here's the part that matters. The new sheriff at the Fed has flatly rejected the pressure to cut. Reports suggest futures markets are pricing in little to no chance of a cut this month, with the odds of a hike increasing week after week. The bond market has already figured this out. The 10-year Treasury yield is sitting around 4.56%, and the 30-year is holding near 5%, after touching its highest level since 2007 back in May. And here's why that's yours to worry about. Every stock you own is in a quiet competition with the US government. Because the moment a Treasury pays you 5%, guaranteed, every risky asset on the planet has to answer one question. What are you paying me for the risk? For most of the last 15 years, that question was easy. Bonds paid almost nothing, so stocks won by default. You could charge any price for growth, because the alternative was zero. That's the world in which today's stock prices were built. But the alternative isn't zero anymore. The safest borrower on earth is now paying real money to anyone willing to wait. And stocks priced for a world without competition are about to find out they have some. So when the market truly accepts that higher for longer is locked in by an oil shock the Fed can't cut its way out of, the repricing won't be gentle. It'll be mechanical. Now, I have to be straight with you because I'm an analyst, not a cheerleader. There's a real bull case, Analysts now forecast about 24% earnings growth this year, up sharply from earlier estimates near 12 to 16%, so maybe profits grow into these prices. And not every energy shock ends in a crash. Back in 1990, oil almost doubled after Kuwait was invaded, and the market fell about 20%, then roared back. But here's the difference. In 1990, the Fed had room to cut and rescue the market. Today, it doesn't. The closest mirror is 1973, when a supply-driven oil shock met sticky inflation. The high-flying Nifty 50 got decimated, and the S&P fell around 48%. And it lagged. The crash came months after the headline, once everyone assumed the disruption was temporary. However, there's a possibility I could be wrong about the timing. Nobody can time this stuff. So what am I actually doing? First, not selling. Selling in a shock hands your shares to the people who've read the playbook at exactly the price they were hoping for. Then, I'm finding out what I actually own. An S&P index fund sounds diversified, but we already know a third of it is a handful of tech names, all priced on the same assumption that money gets cheap again soon. If that assumption breaks, that's not 10 positions, that's one bet. I want to know how big my version of that bet is. Most people have never checked. Second, I'm watching one number. Not the oil price, not the ships, the 10-year Treasury yield. If it stays pinned up here while stocks keep pricing in a rescue, the trap in this video is still armed. If it falls back, the story changes, and I'll change with it. One number. That's the whole dashboard. And third, the part that feels strangest, I'm getting paid to wait. For 15 years, sitting in cash meant losing. That's over. Short-term treasuries pay real money now, and they're the one asset in this story that likes higher rates. Patience used to cost you. Right now, it has a yield. So here's where this leaves us. A closed waterway becomes an oil spill. The spike becomes sticky inflation. The inflation cages the Fed. And the cage drags yields up until the most expensive stocks in history have nowhere to hide. You can't see any of that from the water, because the headline is never where the danger lives. The danger lives in the plumbing, and now you know which pipe to watch. If you enjoyed this video, hit the like button, subscribe, and I'll see you in the next one.